The South African Reserve Bank's Monetary Policy Committee will be announcing its decision on the country's interest rates following a series of meetings that the committee has held this week. Now, the interest rate has been an historical low of 3.5% since 2020. The bank had previously indicated that an increase was likely at the end of the year, or at least beginning of 2022. Let's get the latest now on this, and we're joined by my colleague Nickolaus Bauer, who is following developments. Nick, very good morning to you. So, predictions, I suppose, is what you are looking for at the moment. We don't know what the outcome of the MPC decision is going to be, but what's the sentiment on the ground?
Well, sentiment has been split in the run-up to this decision by Kganyago that will be announced this afternoon, Koli, although people are leaning towards the fact that it will go up or it will stay the same. Definitely not a chance that the repo rate will go any lower than it is now. It's just simply not possible. And even the Reserve Bank's own quarterly predictions are pointing to the fact that interest rates need to increase. So if they don't have a repo rate increase following the Monetary Policy Committee decision this afternoon, it certainly will be the last time that interest rates will be left untouched. Now, we've spoken on the program about the different effect that this will have on consumers, on businesses, and indeed also on the overall South African economy. Let's get a taste of what this will mean for the South African market. We're joined now by Paul Theron from Vestac. We're live from Rosebank. And Paul, what is the market looking for here when Kganyago takes to the podium this afternoon?
Well, it's a global context, Nick, with absolute paroxysm of fear about inflation. You know, everyone's worried about inflation. We've had rising commodity prices. We've had supply chain difficulties since that bloody boat got stopped in the Suez Canal. People are worried about spiking prices, and the middle classes absolutely hate that. And central bankers worldwide are getting into action mode, which is in a way deeply worrying, because we know that higher interest rates in this country won't be great for borrowers, people that have mortgages and home loans and credit cards and that kind of thing. So it is a concern. And let's be honest between ourselves here. South Africa's economic problems are not really a function of interest rates. Yes, I understand the governor's role in managing inflation and inflation expectations, and we have rising prices from external sources and the rand. But really what this country needs is structural adjustment in the economy to get going, to get growth going, and to create jobs.
And also, let's be quite frank. Kganyago has been extremely candid about the fact that it is not the Reserve Bank's main responsibility to go after job growth.
He's an absolute wonder. He is the central banker of the year, I heard. He should run the entire economy. You know, he keeps pointing to the things we need to do. The problem is the real policy makers in economics in South Africa, the leading lights in our cabinet. You know, in the 1950s, they grew up reading Karl Marx, so they cannot understand that we need a freer economy with less restrictions, with a more modest role for the state instead of this fixation with state-owned enterprises, this fixation with tight labor markets, this fixation with competition policy. They need to liberate the economy so that we could actually experience. We've got 30% unemployment in this country. It's a national disgrace. But we're fiddling at the fringes. And in every single speech, you will hear him this afternoon say that we need structural economy adjustments. We need some kind of fresh approach because the current tired policies are not working. But you'll probably also, in addition to that, hear that the interest rates are going to go up.
So let's talk for a second about that fizz that we were speaking about before off camera. The markets fluctuate from day to day. Do you expect a massive swing in what the JSE does today off the back of interest rates?
Well, despite my moaning, the stock exchange is actually at a record high. So we're at about 70,000 points for the JSE All-Share Index. But that's been because the rand's been a bit weaker, because the dollar's been a bit stronger. So stocks like Naspers and Richemont and so on have been moving higher. We've had a little bit of an economic recovery because there are green shoots. Despite the COVID lockdowns and all of that stuff, we've seen a bit of a resumption of investment enthusiasm and consumer growth and retail confidence, and the banks are getting back in the game. So I suspect that the market will probably take this in its stride, whatever happens, whatever happens. But on the ground, you know, when people are kind of looking at their pocketbooks and looking how much money they got left for the rest of the month, an inflation-related adjustment of interest rates is probably the right thing to do. But it's not going to be helpful at the margin because, you know, many people have tight budgets and having to spend more on their home loan, for example, doesn't leave them in a great position vis-a-vis the balance of the funds that they've got available for raising their families and education and food and all that sort of stuff. So I don't know. Forget about the market. The market will do what it will do.
I'll put you on the spot here. Is there going to be an interest rate increase and how much?
I think so. I think they'll probably lead with a modest increase at this time just to sort of signal their intentions and see what happens. I mean, I suspect, 25 basis points or 50 basis points, and it may not be a consensual decision either. It may not be a unanimous decision. That's the phrase I'm looking for. But let's wait and see. You know, I'm not really on the edge of my seat. Like I said, this isn't the biggest issue out there in terms of economics and markets. It's just one of those things that happens along the road.
Oh, Paul Theron from Vestac there. Mgambi, as I keep on reminding everybody, interest rates is just but one ingredient in the recipe for financial success in any market economy, any country's financial situation. And let's see what Lesetja Kganyago says this afternoon, but I'm hearing once again, every single financial analyst, economist, market watcher that I speak to, Mgambi, we need those reforms. Interest rates are not going to really cut it with a 30% unemployment rate and indeed the sluggish economic growth that we were experiencing even before the onset of COVID-19. But all eyes on Lesetja Kganyago this afternoon.
Nickolaus Bauer, thank you very much for that update.